Okay, what is going on, guys? Welcome to Stock Talk with Nico Kritikos. Today, we are going to be doing some stock analysis on Vici properties. Recently, I made a position in this because it is at a record low valuation. As you can see, we are pretty much at a 5-year low here. And I really like the business model. I think they have very safe, predictable cash flow. And that's what allows them to pay out a 7% dividend, which is very hard to find in the stock market. At least a 7% dividend that is safely being paid out. So, if you don't know, Vici is the largest real estate investment trust that specializes in casino, gaming, and experiential properties. They were originally spun off from Caesars Entertainment following the bankruptcy in 2017, and now they have grown into an S&P 500 company that owns iconic real estate for Caesars Palace, the Venetian, and MGM Grand. Okay, so they own those buildings on the Las Vegas Strip alongside dozens of other regional properties. The way Vici makes money is through a triple net lease, which pretty much means that those casinos and their tenants have to pay 100% of operational responsibilities, such as taxes, insurance, and structural maintenance. This gives them a high margin, predictable cash flow without taking on operational overhead or fluctuations in day to day casino gaming revenue. Then they also make money in real estate leases. Okay. Who are their clients? Well, their biggest client is Caesars Entertainment at 38% of total revenue. Now, that is a that's a big chunk, but some people are going to view that as a huge risk and something that's almost a reason not to invest in the stock. I don't see it like that. I see that as that's a great client to have for, a third of your sales, a third of your revenue is based off of that one client. That's a great client to have though. And same thing with MGM, also about a third of their business. So Caesars, MGM, the Venetian, Hard Rock, I mean those are good clients to have in from my perspective. How the rent works. Well, ultra long-term duration. This one is really nice because this gives the initial lease terms typically range from 25 to 50 years, which is just incredible. That's incredibly long-term, giving them predictable visibility into cash flow decades into the future. So just think about that. This is also a very nice aspect of it. Instead of individual leases for each casino, they use master leases, which means that if Caesars or MGM is facing struggles financially, they can't just pick out one location to cut the lease. They have to pay rent on the entire portfolio or they're going to lose the rights to all properties, which is just a great situation for Vici to be in. In the early years of a lease, rent increases by a fixed annual rate of about 2 to 3%. Over the long term, over 90% of Vici's leases transition to CPI-linked escalators, which means they're often subject to standard caps of about 3%. It allows rent revenue to grow organically alongside broader inflation, which is also great. And I think the client should be happy with that too. Tenant concentration risk. So here's one of the risks that people are concerned with. Like I said, I've seen companies, I remember back in the day, like Skyworks Solutions, they used to have over half of their business came from Apple. So there's plenty of businesses out there where they make, 50%, 60% of their sales from just one customer. Okay, so 38% is not that bad, especially when you have a pretty strong client like Caesars or MGM. So over 70% comes from those two operators. If either one would face financial distress or operational shocks, Vici's financial performance would be heavily impacted. But like they said, they have all those things in place where they have the lease terms are literally, multiple decades long. They have it where they can't just cancel the lease on one location. It has to be the entire portfolio. So it's just there's all these things in place to lock in Vici's cash flows and keep it very predictable. Like all REITs, higher benchmark interest rates make Vici's cost of debt capital more expensive and make fixed income alternatives more attractive to yield-focused investors. Okay. Then we have macroeconomic and consumer discretionary slowdowns. Gaming and leisure activities rely on discretionary consumer spending, while triple net leases insulate Vici from immediate drops in casino revenue. Severe recessions strain tenant balance sheets and weaken lease. And again, this is like a hypothetical thing where it's like, how realistic is this? It's not very realistic because unless you really believe that people are going to stop going to Vegas and that whole tourism hotspot is just going to die over the next couple of years, then there's no reason to believe that those companies like MGM, Caesars, the Venetian are going to struggle. That's such a small percentage of that. You can go to almost any casino and it's always busy. Okay. Under GAAP accounting rules, non-cash adjustments on Vici's loan portfolio and lease receivables can cause GAAP net income to swing quarter to quarter, causing temporary bottom line earning misses, even while operating cash flow remains stable. And okay, that's again, look at their numbers. Their numbers. This is not. It's not a high growth company. That's why we're looking at, it's predictable cash flow. The main thing is very small, steady appreciation on the stock price, and the big one is the dividend. You're getting a 7% dividend. That's a big deal. So they grow at 4 or 5% per year in terms of sales and net income. I mean, EPS, free cash flow, all these numbers, they slowly tick up of 7 to 8%, also really good. And I mean, that's really all you're looking for a stock like this. You have a return on capital employed of 7.5%, which is just okay, but works for them. And the profit margins are pretty big here. Now, if we look at the valuation, that's where we are really, realizing what a good deal we're getting here. Because here's the price to sales of a 7, which is historically cheaper than where it normally trades. Free cash flow yield of 9.5%, which is a lot, much higher than what you normally could get. And same thing with the PE. The PE recently bottomed at about 9 times earnings. Now it's about 10 times earnings. And normally it's about 12 times earnings. So even at 9 or 10 times earnings, it's still a great price. Okay. And if you look at it like, let's see, what's the forward PE on this? The forward PE right now is about a 9. If you look at what they're supposed to do, they're supposed to hit $3 EPS next year. So 10 times that would be a $30 stock price, a couple dollars more than it is right now. And if it gets back to a 12 times 3 is what? 36. That would be a $36 stock price next year, which is very realistic. That's where it normally trades. So there's a chance you could make, a decent amount just on the stock price in addition to the 7% dividend. Now, what is the reward of the bull case for this? Number one, like I said, resilient cash flow, 100% rent collection history, even during major economic disruptions. That means a couple years ago in the pandemic, those clients still paid their rent. Okay, that should show you that if those businesses are going to pay rent during the pandemic when nobody's going out, that's a big deal. That means they're going to keep paying their rent. Okay. Strong dividend profile, like I said, 7% higher than what you're normally going to get. Well, watch in a couple months from now. It's gonna when this stock goes up, the yield's gonna go down to only 5 or 6%. Inflation hedge, contractual CPI rent escalators protect long-term purchasing power, like we went over that, and then diversification. They're expanding beyond casinos into other assets like resorts, bowling, and golf. Also great. That's somewhat of a growth catalyst for them. Again, not something I'm betting on or they're relying on, but it's just there. The risk or the bear case for this is, like we said, they're kind of relying on Caesars and MGM, but it's like, is that really a bad thing? I mean, sure, you could have other customers and try to split it where, each customer is only 5 or 10%, but things aren't always going to play out like that. Okay, these are big clients who are spending a lot of money. Growth bottlenecks, because gaming assets are limited, future needle moving acquisitions are harder to execute. We don't need that. We're not looking for that. Like I said, if you're looking for a growth catalyst for this business, they're expanding, they're diversifying into these other resorts and stuff. That's plenty. CapEx demands on tenants. If tenants face rising costs, their ability to cover long-term lease obligations weakens. I mean, we already went over that. They literally paid during the pandemic. I mean, I don't know what else you want. So I think it's a matter of time before we see the stock go back up to over $30 a share. And like I said, you're really betting on that. You're getting a 7% dividend yield right now for a company that can easily afford it. Okay. The payout ratio is 68%. That's very healthy. If we come down here to dividends, you can see that they typically are raising it 4 or 5% every single year. Okay. And this has been steady for going back to 2018, pretty much since their IPO. So to me, it's a great opportunity. And that's why I am bullish on this. Let me know what you guys think down below, and I will see you in the next video.